September 19th, 2024. The Federal Reserve just did something it hadn't done in over 4 years. It cut interest rates. Not a small trim either. 0.5 percentage point, the first cut since the pandemic. Headlines everywhere said the same thing. Mortgage rates are about to drop. People who'd been waiting on the sidelines started calling their banks. Here's what actually happened to the average 30-year mortgage rate over the next 2 months. It didn't drop. It rose from 6.09% on the day of the cut to 6.84% by late November, and it kept climbing. By mid-January, despite the Fed cutting rates 3 separate times that year, a full percentage point total, the average mortgage rate had crossed 7%. If your bank sets your mortgage rate, none of that makes any sense. The Fed cut rates 3 times. Rates went up anyway. Something else is actually running this show, and once you see what it is, a lot of confusing mortgage rate headlines stop being confusing. I am Ellie, and I make a habit of checking the financial advice everyone repeats, but almost nobody actually verifies. If you've ever assumed your bank, or even the Fed, directly controls your mortgage rate, stick around, because the real answer is a genuinely different system, and understanding it changes how you'd actually time a mortgage. Hit subscribe if that sounds useful. Let's get into it. Here's the thesis of this entire video. Your mortgage rate isn't set by your bank, and it isn't set by the Federal Reserve either, not directly. It's set by a bond market, the same market where the U.S. government borrows money, and your bank is mostly just relaying a price that market has already decided. Let's walk through the actual mechanism. When you get a mortgage, your bank almost never keeps that loan. Within weeks, it typically gets bundled together with thousands of other mortgages into something called a mortgage-backed security, a bond-like investment that gets sold to investors, pension funds, insurance companies, anyone looking for a reliable long-term return. Your bank collects a fee for originating the loan and moves on. The actual 30-year commitment gets held by whoever bought that bundled security. It's worth briefly addressing why mortgage-backed security might sound like a loaded phrase if you remember the 2008 financial crisis, because that history is real, but the mechanism itself isn't the problem it was back then. The 2008 crisis involved mortgage-backed securities built from loans that should never have been issued in the first place, made to borrowers without verified income or reasonable ability to repay, then rated far more safely than they actually deserved. The basic structure, bundling mortgages into bonds sold to investors, wasn't the flaw. The flaw was what got bundled and how honestly it got labeled. Today's mortgage-backed securities are built primarily from loans underwritten to considerably stricter standards, and the structure itself has functioned as the normal, unremarkable backbone of the mortgage market for decades, before 2008 and every year since, including right now. Here's why that detail matters enormously. Because your mortgage is about to become a bond, it has to compete with other bonds for the same investor money, specifically the 10-year U.S. Treasury bond, the safest, most liquid long-term investment that exists. If mortgage-backed securities paid the same return as Treasury bonds, no rational investor would buy them, because Treasuries carry essentially zero risk of default, backed directly by the U.S. government, while mortgages carry at least some risk that people might refinance early or, in worse scenarios, default. So mortgage-backed securities have to offer a higher return than Treasuries to attract the same money. That extra return is called the spread, and it typically runs about 1.5 to 2 percentage points above the 10-year Treasury yield. Add that spread to whatever the 10-year Treasury is currently yielding, and you get, roughly, the mortgage rate being offered that day. Not a number your bank invented, a number the bond market already set, that your bank is essentially just passing along. Here's a way to picture this that makes the mechanism easier to hold on to. Imagine an auction room where investors are choosing between 2 nearly identical-looking boxes to put their money into for the next 10 to 30 years. One box is labeled Treasury bond, government guaranteed, completely predictable, but a relatively modest return. The other box is labeled mortgage bond, backed by thousands of individual homeowners' payments, slightly less predictable, since some of those homeowners might refinance or sell early, but historically very reliable. For investors to choose the mortgage box at all, it has to visibly pay more than the Treasury box, enough more to make the extra unpredictability worth accepting. Your mortgage rate is, in a very real sense, the price tag investors are willing to accept on that second box, translated backward into what you get charged to borrow. There's a specific reason mortgage-backed securities need that extra return beyond just mortgages are riskier than treasuries, in a general sense. And it's worth understanding because it explains why the spread itself moves around so much. The biggest specific risk investors price into a mortgage bond isn't default. Most homeowners pay their mortgages. It's prepayment risk instead, the possibility that you refinance or sell your home years before the loan term ends. That hands the investor their principal back early, right when interest rates have likely fallen, forcing them to reinvest that money at a lower return than they were expecting when they bought the bond. Treasury bonds don't have this problem. The government pays exactly on schedule for exactly the stated term. Mortgages might get paid off in year 3 or year 23, and that uncertainty itself has a cost, which investors demand compensation for through a wider spread. This is also why the spread between treasuries and mortgage rates isn't a fixed number. It moves based on how uncertain the market feels about the future. During calmer periods, the typical spread sits around 1.5 to 2 percentage points. During periods of real economic uncertainty, like much of 2023 and 2024, that spread widened to as much as 3 full percentage points. Investors demanded significantly more compensation for the added risk of holding mortgage bonds during a volatile stretch. That widened spread, separate from anything happening with the 10-year Treasury yield itself, was a meaningful part of why mortgage rates stayed elevated even as other parts of the rate picture started easing. This is exactly why the September 2024 story makes sense once you know the mechanism. The Fed funds rate, the number that actually moved on September 19th, is the overnight rate banks charge each other to borrow money for a single night. It's a completely different number from the 10-year Treasury yield, even though both get reported as interest rates and easily get confused with each other. The Fed's cut lowered short-term borrowing costs immediately. It did not directly touch the 10-year Treasury yield. That yield responds to a different set of expectations entirely, specifically what investors think inflation and economic growth will look like over the next decade, not what the overnight bank lending rate is this week. In the weeks before that September cut, investors had already priced in the expectation that it was coming, which is actually why mortgage rates had already dipped slightly beforehand. Once the cut was officially announced, attention shifted to what would happen next, and the incoming economic data, stronger job numbers, stickier inflation than hoped, made investors nervous that future cuts might be slower or smaller than expected. That shifted expectations pushed the 10-year Treasury yield higher, and mortgage rates, tracking that yield closely, followed it up, directly canceling out whatever downward pressure the Fed's actual cut might otherwise have created. It's worth knowing specifically who's on the other side of this transaction, because investors can otherwise sound abstract and mysterious. Mortgage-backed securities are purchased by a wide range of large institutional buyers. Pension funds look for steady, predictable, long-term income to pay out retirees decades from now. Insurance companies match long-term liabilities with long-term assets. Foreign governments and sovereign wealth funds seek safe dollar-denominated returns. And the Federal Reserve itself has, at various points, bought enormous quantities of mortgage-backed securities directly as part of its broader monetary policy toolkit, separate from its more famous federal funds rate decisions. When the Fed was actively buying large volumes of MBS during and after the pandemic, that extra demand pushed mortgage rates down independent of what the federal funds rate itself was doing. This is actually a second, less discussed way the Fed does influence mortgage rates, just not through the mechanism most people assume. Let's make this genuinely concrete with 2 people shopping for a mortgage around that same September 2024 moment, because the difference in what they paid attention to actually mattered. Person 1 heard about the Fed's rate cut, assumed mortgage rates would keep falling in the following weeks, and deliberately delayed locking in a rate, waiting for what they expected to be a better number. 6 weeks later, rates had risen from 6.09% to over 6.6%. The delay cost them a meaningfully higher rate locked in for the next 30 years, purely because they were watching the wrong indicator. Person 2, shopping for a mortgage during that same window, didn't try to time the Fed at all. They tracked the 10-year Treasury yield directly for a few weeks, noticed it ticking upward on stronger than expected economic data, and locked in their rate promptly. They didn't wait for a Fed-driven drop that the underlying bond market was already signaling probably wasn't coming. Same starting point, same market conditions, a meaningfully different outcome, entirely explained by which specific number each of them was actually watching. So if your bank isn't the one setting your rate, and the Fed isn't directly setting it either, what exactly does your bank control? A real, specific piece, just a smaller one than most people assume. Within that mortgage-backed security bundling process, there's a portion of the spread specifically reserved for the lender itself. It covers the actual cost of originating your loan, underwriting it, servicing your monthly payments for years afterward, and a margin of profit on top. This piece is sometimes called the primary-secondary spread, and it's genuinely where a bank has room to compete, charging more or less depending on their own operating costs and how badly they want your specific loan. On top of that, your bank absolutely does control your personal rate within that day's market baseline, based on factors specific to you. Your credit score is the biggest lever, since it directly signals default risk to whoever eventually buys the bundled security your loan sits inside. Your down payment size matters too. A larger down payment reduces the loan-to-value ratio and reduces investor risk accordingly. The specific loan type, fixed versus adjustable, conventional versus government-backed, shifts the pricing as well. None of this changes the baseline the entire market is working from that day. It changes where you land within a range around that baseline, sometimes by a meaningful amount, a full percentage point or more between a strong file and a weak one, but always within boundaries the bond market set first. Here's a specific misconception worth clearing up directly because it comes up constantly. The Fed raised rates, so my adjustable rate mortgage payment went up is actually a completely different and correct statement, which is part of why the confusion persists. Adjustable rate mortgages and other short-term lending products like credit cards and home equity lines genuinely do track the Fed funds rate closely, since those are short-term products priced off short-term benchmarks. A fixed 30-year mortgage is a fundamentally different product, priced off a fundamentally different, longer-term benchmark. The Fed controls my adjustable rate, and the Fed doesn't directly control my fixed rate are both true at the same time. That's exactly the kind of nuance that gets lost when headlines compress everything into the Fed and rates. This same mechanism explains why refinancing decisions deserve the same framework as a new purchase, rather than assuming a refinance should wait for a Fed announcement either. If you already have a mortgage and you're wondering whether it's worth refinancing, the relevant comparison isn't your current rate against whatever the Fed just did. It's your current rate against where the 10-year Treasury yield and its spread currently sit, translated into today's mortgage rate. How large a gap actually makes refinancing worth it varies by lender and by your specific loan balance and closing costs. Different guidelines range anywhere from about half a percentage point to a full point, so it's worth running your own numbers rather than assuming a single fixed threshold. But that comparison, today's rate against your existing one, is what actually matters, regardless of what the Fed's most recent meeting decided or is expected to decide next. Here's what this actually means, practically if you're trying to time a mortgage or understand a rate quote. Watching the Fed's meeting calendar is watching the wrong thing, or at least an incomplete thing. What you actually want to watch is the 10-year Treasury yield itself. It moves daily, sometimes hourly, in response to inflation reports, jobs data, and shifting expectations about where the economy is heading, not simply whatever the Fed's next scheduled decision happens to be. A Fed cut can coincide with mortgage rates falling when the cut itself is a surprise that shifts expectations downward. It can also coincide with mortgage rates rising, exactly like September 2024, when the cut was already expected and attention immediately shifts to what happens after it. If you're shopping for a mortgage, the actual lever within your control isn't waiting for a specific Fed announcement. It's your credit profile, the size of your down payment, and comparing the specific spread different lenders are charging on top of that day's baseline rate, since that's the genuinely negotiable piece. Two lenders quoting you different rates on the same day aren't disagreeing about where the bond market is. They're charging different amounts for their own piece of the transaction, which is worth shopping around for specifically, rather than waiting on a Fed decision that may not move your rate the direction you're expecting at all. Your bank was never lying to you about your rate exactly, but it also was never the one deciding it. A bond market thousands of investors are actively trading in every single day set the baseline before your bank ever quoted you a number. Understanding that doesn't just explain a confusing headline from 2024, it tells you specifically what's actually worth watching and what's worth shopping around for the next time you're the one waiting for a rate to move. There's always more to the advice than the headline version. Subscribe if you want to keep digging into it with me.